Today, the wrecking ball swings again. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and proper news with a distinctively Australian flavour. Well, the Dow on Thursday suffered its biggest one-day slump since 2020, driven by an ugly sell-off in technology stocks as Treasury yields climbed to multi-year highs. That's just a day after the Federal Reserve delivered its biggest rate hike since May 2000. As to the trigger, well, Britain's pound and government bond yields slid on Thursday after the Bank of England raised interest rates to their highest since 2009, but warned that the economy was at risk of recession. Sterling tumbled by more than 2% against the dollar to a low of 1.236. That's the lowest since July 2020. And it was set for its biggest one-day fall since March 2020, when the spread of the COVID-19 pandemic wreaked havoc on world markets. The pound slumped 1.4% against the euro to its lowest levels since December 2021 at 85.45. That meant the euro was poised for its best ever day against sterling since September 2020. Now, the Bank of England kept its forecasts for economic growth this year at 3.75%, but slashed its forecasts for 2023 to show a contraction of 0.25% from a previous estimate of 1.25%. And it cut its growth projection for 2024 to 0.25% from a previous 1%. The Bank of England Governor Andrew Bailey said the forecast did not meet the technical definition of recession, but of a very sharp downturn. The weakness of the growth outlook means that the inflation outlook is pretty weak too, said Chris Shisluna, head of economic research at Daiwa Capital Markets. Markets are right to take a step back, and we had thought the scale of tightening that was priced in was excessive. The Bank of England revised up its forecast for price growth, which now shows consumer price inflation peaking above 10% in the last 3 months of this year. It had previously predicted a peak of about 8% in April. A split also emerged in the rate-setting Monetary Policy Committee, with 2 members saying the guidance was too strong, given the risk to growth, while 3 policymakers voted for a larger 50 basis point hike. 2 members' suggestions that further hikes are not appropriate is resonating, said Neil Jones, head of hedge funds at Mizuho in London. In bond markets, gilt yields fell sharply as investors reassessed that rate outlook and as the Bank of England appeared in no immediate rush to start selling the government bonds that it holds. 2-year gilt yields were last down 13 basis points on the day at 1.141, having hit a 1-month low. London's FTSE stock index took comfort from moving currency. It actually closed up 0.13%, so it'll probably fall tomorrow. The financial services index did already fall 0.57% to 755.78. Adding to the UK issues are the local elections, where Johnson's Conservative Party is expected to lose more than a third of its local council seats across Britain, an outcome analysts say will increase pressure on Johnson to quit, following a series of scandals linked to the COVID pandemic. And by the way, in passing, note too that core consumer prices in Tokyo, which is a considered leading indicator for Japanese price trends, rose 1.9% in April from a year earlier, marking the fastest annual pace in 7 years, according to data just released. The increase in inflation, driven mostly by energy costs and the dissipating effects of past cell phone fee cuts, underscores a common view among economists that Japan will see price rises accelerate to around the central bank's 2% target in coming months. The rise in the Tokyo Core Consumer Price Index was faster than the median market forecast for a 1.8% gain, and follows a 0.8% increase for March. By the way, the index excludes fresh food, which is a volatile factor, but it does include energy items. The Bank of Japan last week raised its forecast for this year's inflation rate, but kept its ultra-loose monetary policy unchanged, stressing its resolve to maintain massive stimulus until inflationary pressures were accompanied by wage rises and stronger demand. Well, have you heard that before? Now back to the US markets, where stocks ended Thursday sharply lower amid the broad sell-off as investor sentiment cratered in the face of concerns that the Federal Reserve's interest rate hike the previous day would not be enough to tame surging inflation. All three main Wall Street benchmarks erased gains made during the relief rally on Wednesday, with the Nasdaq posting its biggest one-day percentage decline since June 2020 and its lowest finish since November 2020. The Dow's decline was its worst daily performance since October 2020. It fell 3.12%. The S&P 500 lost 3.56% to 4,146, and the Nasdaq Composite dropped 4.99% to 12,317. Technology mega caps slumped, so you can look right the way across the board there with Google's parent Alphabet, Apple, Microsoft, Meta Platforms, Tesla, and Amazon all falling somewhere between 4.3 and 8.3%. No wonder the market was down. Twitter, though, bucked the big drop in tech and ended the day more than 2.6% higher, following a CNBC report that Elon Musk is likely to become temporary chief executive of Twitter after he completes his $44 billion takeover of the social media platform. And Twitter closed at 50.36. Consumer discretionary stocks also added to the market turmoil, driven by a sell-off in Etsy and eBay, following guidance that spooked investors about the outlook ahead. Etsy slumped more than 16% as its better-than-expected first quarter results were offset by second quarter guidance weighed down by deteriorating macroeconomic conditions, including the impact of inflation on consumers. Management noted that the deceleration that Etsy started to experience in February worsened and continued into April, Wedbush said in a note. And eBay cut its full-year guidance and forecast softer growth for the second quarter, sending its shares more than 11% lower. Energy stocks ended the day in the red, even as oil prices climbed from the session lows after OPEC and its allies stuck to plans to lift production by 432,000 barrels per day from June. The sell-off hit all areas of the market as traders headed for the exits, not just high-growth stocks, which have struggled in 2022 as the prospect of rate rises had investors questioning their future earnings potential. Investors aren't looking at fundamentals such as earnings right now, and this is more of a sentiment issue, said Megan Homan, Chief Investment Officer at Verdence Capital Advisors. Despite Fed Chair Jerome Powell explicitly ruling out a hike of 75 basis points in the coming meeting just yesterday, traders, however, on Thursday raised their bets on a 75 basis point hike at the Fed's June meeting. We now see a third 50 basis point rate hike as likely at the July FOMC and 25 basis points for the balance of the year, bringing the Fed funds rate to the end of 2022 to 2.625%, Morgan Stanley wrote in a note. Worries about Fed policy moves, mixed earnings from some big growth companies, the conflict in Ukraine, and pandemic-related lockdowns in China all hammered Wall Street recently, overshadowing a better-than-expected quarterly reporting season. You're seeing those areas of the market which are purely discretionary. They're the ones getting hit today because everyone is anticipating that this is going to be a challenging period for consumers over the next several quarters, said Horniman of Verdence Capital Advisors. The 10-year Treasury yield briefly jumped to 3.1%, its highest level since November 2018, just the day after the Fed delivered the 50 basis point increase. There had been some hope that as the 10-year Treasury yield approached 3%, things might stabilise, chief strategist at Sprouting Rock Asset Management, Rhys Williams, said in an interview. Over the last 15 years since the great financial crisis, economies have slowed once the rate on the 10-year Treasury crossed 3%. I think it's a bit concerning that rates haven't slowed, and that's why the markets are reacting poorly to that, he added. As the 10-year yield breaks above 3%, it could soon run into levels that could offer resistance. The next objective for the 10-year Treasury yield would be around 3.25%. I think that's the next reasonable point where you could see yields reset a little bit and see things sort of normalise. Chief market strategist David Keller at Stock Charts said. The 10-year closed at 3.074%, while the 2-year was up 0.14% to 2.7545. The volatility index, also known as the Wall Street Sphere Gauge, climbed to 3120. That's up a massive 22.74%. WT oil was down 0.19% to 107.84, while gold slipped to 1,871, and Bitcoin crashed 8.2% to 36,408. The dollar index was down slightly to 103.56, though still maintaining its strength. And in morning trade, the ASX 200 was off more than 2% at around 7,204, while the Aussie was up a little to 71.20, and the 10-year bond was 3.49% higher to 3.514, while the 2-year was up 3.3% to 2.814. So the markets are looking for higher rates ahead. Now the focus shifts to the US Labor Department's closely watched monthly employment report, which comes out in the US on Friday, for clues on labour market strength and its impact on monetary policy. But the value wrecking ball is now swinging freely, and given the risks from stagflation ahead, markets will remain volatile with a strong downside tilt. So frankly, trying to find fair value for now is, well, all but impossible. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.